Hello everybody, my name is Tuff. Welcome to my channel. Long time no see, it's been a month at least without talking to you or making any videos. So I'm glad to present you today a different style of company that I've never made. It's a pharmaceutical company, and that one is called Catalyst Pharmaceuticals. So I just remind you before I start that I'm not a financial advisor, and then any time you buy a company, at least you need to do your due diligence before you do. So this company is Catalyst Pharmaceutical, specialized in rare disease drug treatment. And what I like about this company and I really love to share with you today is that the business model is so simple that it's very difficult to get wrong on this one. This is at least my opinion, and today I'd like to share that with you. That company, Catalyst Pharmaceuticals, actually only have one product. They developed it in 2018 to treat the LEMS disease. They commercialized it since 2018, and here is the revenue in a blue bar that actually increased year over year from 102 to 119, and last year 141. Obviously, we want to know when a company does that, if it's going to stabilize or keep on increasing and increasing. This is super important for us about the story. And the indication that they give us today is that the growth is not going to stop. First point is at the moment this Firdapse product, which is a drug that they are selling, has treated over 800 patients in US, where actually the total addressable market is 3,000. Right now there's not much competitor, or at least the last one has been kicked a few months ago, so basically they have the entire possible market for themselves, which would represent maybe a 2x or 3x on that. On top of possible expansion in US, they are also expanding in Canada, that they recently had an authorization in, actually no, not recent, but 2 years ago, a year and a half ago, that counts for possibly 300 additional patients. So I don't know exactly what is the penetration of Canada. Maybe some point we need to dig a little bit more. And Japan also, where they are actually developing a phase 3 in conjunction with another company there to help to facilitate. So it's called Daido Pharma that will develop and market the product. And basically, there are also possibly as much or more possible patients to treat there in Japan, which could be also a possible multiple of revenue addition to the company. Also, look at this 10-year possible market exclusivity upon arrival. On top of this, they are trying to treat the little kids, so they are trying to make get an FDA approval to treat around 30 patients at the moment that have the LEMS disease. So it's not much, but it's nice to see that they are trying to expand in every possible niche they're possible. A geographic expansion and also a patient expansion. Here I added a few slides for your information about the last presentation they had. If you want more details, I think it's even better to go on their website and to dig a little bit more into the slides. An interesting point that I'd like to share with you is today, in these days of recession, it's quite difficult to find a good company that actually has a low possibility of loss. I explained is basically we want a possibility for high reward but low risk. And to me, the fact that this company has 5 US patents that protect their drug until 2034, it's a commitment to say that basically the company will not suddenly lose revenue of their only product. And that comforts me as an investor to put a little bit more money because I know that there's a little chance of revenue loss over the next years. And if you make a quick calculation from 2022 to 2034, this is 12 years. At the moment, last year, they were only making $60 million per year of operating cash flow. You multiply by 12, this is a potentially $720 million. And basically today, until the end of use of patents, and we consider no expansion in any other country, nothing, just like really something steady. and the market cap today is 720, so basically they could buy back the entire number of shares if the share price stayed at that price until 2034. So very interesting. There's for me at least a very good comforting point here that tells me, okay, maybe we will not buy, we will not, let's say, get more, but at least we won't lose any of the share price. Now let's switch to the numbers because you have the story now, and I'd like to continue with the possible revenue just to see what share price we can give, and that's the next step. Where are we heading to with all the information that we have today? So just to split the revenue, obviously you have to manufacture the products. So you have the part of the revenue that is spent for the manufacturing, for selling, and for developing the product. What is left is the net income before tax. On that, you apply the income tax, and then what is left is what you're interested in, is the cash. This cash, based on the number of shares and after the PE ratio that you want to apply, you can expect a certain share price target. Now let's move on to the DNA card. I think it's super important to present you the situation as of today with a share price of $7. That's very important. Today, the company has a lot of cash and short-term is around $200 million. Their market cap 720, which gives them an enterprise value of $525 million. Based on this and the free cash flow that they generate, they have around 10% of yield, a P of 10 basically, but a real P of 10. On top of that, they are what we call a very great operating leverage. What does it mean? Let me come back to the last slide. Sometimes big growth stocks, they love to show revenue growth like 100%, 200%, something crazy. But they don't realize that at the same time, or we don't realize that at the same time, the sales, the research and development is actually tripling or quadrupling when the revenue is only doubling. So basically this part, the yellow part, gets smaller and smaller as the revenue grows. And that's the opposite of operating leverage. What you want is a revenue increase and then maybe a steady or even decreasing sales R&D. And that's almost the case of Catalyst Pharmaceutical here. In terms of gross profits, it's boosting. So you see you have the different years here and trailing 12 months. And basically, R&D stays steady over the last years because they've developed their drugs. They don't have to do much more R&D. And obviously, they are spending a little bit more for the marketing to sell the drug, to make advertising. But obviously, look, when you look at this slope and that slope of gross profit, you can see that there's a very, very huge operating leverage. So that's what you need to see here, at least to remember: a good yield, a lot of cash, and operating leverage. These three stuff are magic. No debt also. What else do you want in these days where the market is actually suffering? You want at least a company solid like this. Here I made a complete summary of all these informations. So the only one that I didn't mention as of now is the buyback. They announced that in Q1 they did a 2.6 million share buyback at $14.6 million, which is an average price of $5.6. Guess what? It's a fantastic buyback opportunity. It was good. The recession at least is very good for people, for companies that have money and realize that the price is so ridiculous that they buy back some shares. Also, another point I did mention, or maybe briefly, is the removal of the Ruzugi, which was the competitive product for the LEMS treatment that has been removed in February. So you will see that on the next quarter, you will have organic growth, so the development, like the typical growth that you see over the last 2 years, plus a conversion from the client from the Ruzugi. So what else do you expect? Also, what is important for us to develop an operating model is be able to treat the information that, for example, the guidance. When a company gives guidance or outlook, it's fantastic. Why? Because it gives you like an idea of the direction. And you know if the company is actually, how to say, reliable in terms of promise, or if they are under promising or over promising. And that company on Catalyst Pharmaceutical has a good track record of following the guidance. And they guide for $200 million of revenue, which guess what? It's a 40% increase compared to 2021. So it's a company that has a P of 10 and that is already promising 40% revenue increase. How can you not love that? So now let's try to build up the operating model based on that guidance. Okay, and let's see what earnings per share we're gonna get and then possible share price. That's what you see here. This is the magic table. So I tried to follow up the guidance of $200 million. So the numbers in red are the ones that I, let's say, estimated. Huh? So that's just a hypothesis. In red, this is what happened in the past. So as you can see, my estimation for the 2021 is between 7 and 8.9. So we're not bad. We're in this range at the moment, we're at $7. But what you can see is that based on this revenue increase, keeping the same gross margin, you get $172 million of gross profit. You remove the OPEX that I guided between $65 and $70 million. It gives you earnings before tax. You remove the 25%, which gives you $78 million. And then you divide by the number of shares, which gives you an EPS number of $0.7. On top of that, don't forget that they have a lot of cash, and that has to be taken into account for the share price estimation. $197 million of cash and short-term investment. You divide by the number of shares of 109, and it will give you $1.8 of cash per share. Now, easy. Considering that the company is going to grow 40%, maybe not over the next years like this, continuously, but I would guess that the company is worth at least a P of 15 today, or maybe 20. And that's how you make the calculation. EPS multiplied by the P ratio, 15, and you add up on top of that, for example, $2.5 of cash that I estimated for the last quarter. What does it give you? 13.3 for a P of 15 and 16.8 for a P of 20. Bon, you can see from a share price of 7 at the moment, it's possible 100% increase. Also, what is very important here to understand is that this share price target is based on the result whenever they deliver Q4 2022, which usually is in March next year. So basically, it's even less than a year from now. And this is where sometimes people, promise 100% return within the next 5 years. Now, the compound annual growth will be lower. But here, it's a possible 100% increase by next year, by the next 12 months. And that's what I really like in this company. I think it's quite secure. This is only my opinion. Of course, you need to do your own research before buying it, but this is the situation. So now let's summarize a little bit what we had for this company. More pros obviously than cons, but steady income at the moment, a good P ratio, still growing, and actually very rapidly, 40% for 2022, as I mentioned. Lots of cash, ready to buy, to make new acquisition, and actually this is the best time these days because the biotech world actually has been smashed by the recession. So if you want to buy a company today, if you have cash, this is the best timing because everything will be on discount. So they will have actually maybe possibility to buy back and at the same time buy companies. The US patents protecting them until 2034, 2026 in Canada, and then possibly if they have the drug in Japan, it's going to be 10 years. So it's going to be fantastic, a good securing. Trying to expand, of course, these field apps in Japan. Buying back shares if the share price, for example, goes too low over the next months. If there's another like big market crash, for sure they will buy back because they know that the company is much more worth than a $7 price. No supply chain issue at the moment. Huh? You don't need much to make a drug. That's good. On the cons, I just see a little ownership on the management. I would have loved to see like a 20% ownership on one of the managers or the CEO, for example. Also, but at the moment they just have one product. Of course, it's not like just like a supplier for a big company like cell phone component company selling to Apple that might be kicked in one go like this. They have patience, and well, I don't say that it's sticky, but if you have a good treatment, you usually don't change the treatment like this from one to another. Also, the last point that I didn't mention is a possible short ratio of 7% of the shares. Let's keep an eye on this, because sometimes, you know, some analyst companies, they just, let's say, build up their short position, and then after issue a short report that can sometimes make the share price drop significantly. So 6% is nothing major, but good to keep an eye over the next months just to be sure that it's not increasing. Anyway, I think that's it. Just last slide. If you're interested to their extract from their conference call regarding the acquisitions, I think it's very important to read, so you can put pause on the video and then have a read. But anyway, I think it's a good company. I hope you liked it, and I hope also you learned also the process of evaluating a company. For me, it's super important. And that example is great because it's a very, very simple company with just one product. They might expand, they might buy a new product. So it's super simple, and I think it's a good risk reward at the moment. Low share price, and yeah, possibility to have a good reward and low risk. So anyway, I hope you liked it. Just tell me in the comments if you have any idea of companies that could be like this, or any comments regarding my presentation, any recommendation, whatever. Just put all the comments you want in the video, and we make it interactive, because the most important is that we build the knowledge together. And without any feedback, it's difficult to get better. So I appreciate your return, and then I see you soon. Bye bye.